What my role is in this conference and what I do on a regular basis, John Stewart and Associates, many of you may not know who that is. We just shorten it to JSA. But JSA is a commercial brokerage firm. So we're a commercial consulting firm, brokerage firm. We've got about 60 brokers all across the Midwest. We have about half the company that specializes in production agriculture at the farm production level. We have the other half that focuses on the commercial level. So our commercial risk management side is where I spend most of my time. That is hedging strategies, margin strategies for the livestock sector, for the production ag farmer sector, for the ethanol sector, for the biofuel sectors as well. So we spend a lot of time, trying to evaluate big market moves, big market pictures, what's moving the market fundamentally as well as technically, and spend some time with that. I'm going to move around this stage a fair amount. I hate podiums. I'm not a podium guy, so we're going to move around a little bit. But anyway, that's my background. I'm pushing 30 years now, so we're getting there. I really prefer, if we can, if there's any interactive questions that you have as I go through, that you would just shout those out. We don't have to wait till the end. Sometimes, something sparks you right at that moment. Do not be hesitant at all to ask questions as we go along. We are in a state of significant change. I think a few of the first talks that I heard at this conference as I was just listening, I don't think we should be surprised by that. We're always in a state of change. We're always adjusting to things. We're always moving. You might say we move from one crisis to another crisis. I don't know that I want to be that negative on all this, but I do think we're always in a constant state of change. We had a change that happened politically, administratively, on January 20th that changed the way markets are behaving. One of the things that has changed is our day-to-day volatility has increased, and we need to get used to that. Okay, we went through a period of time that was relatively stable. In my world, some of that's considered boring, but we're in a state of change now from day to day, headline to headline, that we haven't seen for a while, and we need to get used to that for the next 4 years. We have a head of the administration that wants his name on the top of the newspaper every single day. Now, he wanted his name on the top of the newspaper for the last 4 years. It just didn't mean anything. Now it means something. It actually can affect change. We can issue 100 executive orders in 24 hours. And all of these things have consequences. The market was down in a lot of areas Monday night. Last week, trade war with Colombia on. 24 hours later, trade war with Colombia off. We were down hard Sunday night into Monday. Trade war with Canada, China, Mexico on. Okay, now it's not. Now it is. Now it's going to be next month. What does it mean? All these things have market responses to them. If you calculated your net return per acre, your net return per barn, your net return per gallon in the last 24 hours, you had daily ranges of 5, 6, 7% in profitability just on some of those moves. So that's a volatility ride. It's exhausting, but it is something we need to get used to. It's the political risk of the new administration, the environment that we're in, trade wars, tariffs, etc. You can call it the next challenge that you have, but we're used to those, right? Challenges are also opportunities. You just got to flip them on their head. So biofuels policies are a big one. This group in here, I'm always a little bit hesitant. I do a lot of biofuels talks, a lot of pro-biofuels groups when I get in front of a group of livestock folks, whether that be cattle or not, or poultry or the pork industry. I'm always hesitant to talk too much about biofuels because it's sometimes a dirty word. We have a administration that went through a very green movement with the Inflation Reduction Act and all of the various carbon credit systems that have been tried to be generated. I'm speaking really generically here on the Inflation Reduction Act, but there's been pieces of that legislation from about 3 years ago that have touched agriculture in so many different ways. We've had grain producers looking at climate-smart farming practices. We've had technology companies looking at how to capture that data to understand what type of cover crops you're going to use or what type of fertilizer you're going to use in order to capture premiums for doing certain things and certain practices. There's energy pieces all the way through the manufacturing chain to a gallon of diesel to a gallon of gasoline that if you do these certain things, you're eligible for carbon credits. And that whole system we've just thrown a ton of sand in the gears. We don't know where that's going to go. Okay, we had a bunch of rule clarifying pieces of proposal come out right before the administrative change on January 20th. But the comment period is 60 days, and we're in the middle of that comment period on all this stuff like 45Z, 40B, 40Q. If you've heard of any of these, those are IRS tax codes in the Inflation Reduction Act. Okay? And what we've created today is a whole bunch of people sitting around saying, what's going to happen next? And the answer is we don't know. We absolutely don't know. We have an EPA secretary who's going to be responsible for enacting some of these things along those renewable fuels channels. That is almost a polar opposite of the EPA secretary we had the last 4 years. So that's the kind of state of change that I think we're in, and agriculture is not going to be immune to any of it. We have a president who on the campaign trail said we're going to end the Russia-Ukraine war on day one. Okay, that didn't happen. Nobody expected that to happen. But I do think it's coming to an end at some time in his 4 years, and maybe soon. I think we have a very different approach now than we had the past 4 years on what aid looks like to Ukraine or not. My focus on it is not necessarily the war, even though that's a very important geopolitical piece of it. My goal on what that does when we change that is not to get involved in the geopolitics of where the line is drawn in Ukraine, and this is now Russia and this is Ukraine, and how that may change and may be different. For agriculture, it means I've got 15 to 20 million tons of production coming back online in one crop cycle. That's right now in a war zone. So whether it's Russian land or Ukrainian land doesn't really matter. What matters is the war has to stop. So we have all that kind of uncertainty going on. We got South American production. I'm going to get to that in a minute. I will not spend much time on a January crop report. That is not important really for this group. We're going to talk about some global supply shifts. We're going to talk about value-added initiatives that I think are going to be one of the most important initiatives in the next several years because of the trajectory of how whole grain production is changing around the world. And we're going to finish with that one. This is a chart of the US dollar versus the Brazilian real. I'm not going to try to turn into an economist on this one. I do want to point out that the tariffs have been one of the most predetermined piece of change in the last 2 to 3 months, especially once Trump was elected in November. One of the ways that countries all around the world can soften an impact of tariffs is by weakening their currency versus the US dollar, strengthening the US dollar. We can talk about the US dollar as the world reserve currency all we want, but if you are a country that has a risk of a tariff being imposed on you by the United States, and that tariff is 10%, and you reduce your currency in relationship to the dollar by 5%, you've just negated from an import-export balance the effect of that tariff. So that's been happening long before the administrative change occurred. So tariffs are something that we've seen this song and dance before. I think how the markets respond is going to be different than how it was the first time. We know that they can follow through, we know that they can stick, and we know that the market can respond. Okay? I mean, there's some impressive stats out there around different countries in the world that have tariffs and how well they're doing or not doing in different things. So tariffs aren't necessarily the end-all, be-all. But it is going to be a volatility creator, okay, especially in your market segments. Here's a chart of used cooking oil. So the first question you should ask yourself is, what in the world am I doing looking at a chart of used cooking oil on a Tuesday afternoon in Manhattan, Kansas? And that is, this is the best chart that I can show you of policy implications and market responses and what that means. And I'm using something as mundane as used cooking oil to describe it. First question, used cooking oil and other soybean oil sources or corn oil sources, all sorts of vegetable oils, can all be used as a feedstock to make biodiesel and renewable diesel. It's also an energy source. You guys know all of this. Various forms have different energy properties into a feed ration, into a performance ration. Okay, when the Inflation Reduction Act came out in about 3 years ago now, there was a major incentive put in place for the use of used cooking oil as a feedstock for renewable diesel in all the renewable diesel refineries that were being built that way. And these are the Chevrons and Marathons and Phillips 66s that were all putting this money in. And it was the biggest tax credit return feedstock for a renewable diesel gallon. So if you had soybean oil that made renewable diesel, your tax credit might be in the range of 15, 20 cents a gallon. It had to do with the carbon intensity score of the feedstock. Used cooking oil carried one of the lowest feedstock uses, or feedstock values for carbon intensity, that premium was 65, 75 cents a gallon if you made renewable diesel from used cooking oil. Used cooking oil. The problem with that, before the bill was passed, do you guys know how much used cooking oil we were consuming in this country for all the various sources that we can use it for, whether it be feed or energy? Anybody have any idea what percentage of used cooking oil? We weren't just digging a hole and throwing the stuff into the ground, right? We were doing something with it. It was in the 94, 95% range. And now you have this massive group of energy processors, refiners, scrambling to buy all the domestic used cooking oil they could. The stuff went from 14, 15, 16 cents a pound to 60 cents a pound. It affected everybody in the industry that needed extra energy components within their feed. And then all of a sudden, we developed an entirely new market on accident of bringing in used cooking oil from around the world. The red bar there's China. The blue bar, the blue bar's Canada. The purple is Malaysia. And there was an unintended consequence of that bill. So we were using U.S. taxpayer dollars to give a tax credit to a California refiner for bringing in used cooking oil from China, which most of it wasn't even used cooking oil anyway. You fill up a big tanker full of cooking oil or of soybean oil in China, you throw 4 French fries in it, bring it out, and now it's used cooking oil. And you change how much money in tax credit you got from that in a very substantial way. We totally altered trade because of that. Totally influenced the animal fats market, the tallows markets, the greases markets, affected all of it. Because of a carbon intensity score, of a feedstock and an Inflation Reduction Act biofuels policy that probably didn't get much more than 10 minutes of discussion. So these are the types of things we need to kind of, the speaker right before me, I'm sorry I didn't remember your name, but all those legislative activities have consequences, and all those things need to be watched and monitored closely. Those jobs are very important. I think in the first 12 months of Trump's term, how many bills do you think we're going to pass in Congress in the first 12 months of the year? Anybody want to take a stab? Throw out some numbers. How many bills are we going to pass? Congressional bills. I got my guess. Anybody got one? Oh, come on. I'm failing. I'm already got to get the horse races stopped. Okay? 1. I'm going to say 1. I bet in March or April we will have one massive omnibus bill that covers everything from toothpaste to tanks. Okay? Because that's the only way we're going to get it passed. If we try to have issue by issue bills, it takes too long, can't get everybody to agree. We got to throw about 51% good in something to get 51% to pass. The other 49% we don't like, but that's the way we get bills passed now. It's a very big challenge that we have, okay? But it's going to create volatility, and I'm not saying good or bad, I'm saying volatility. I've already talked about the Russia-Ukraine war a little bit and how that's going to impact us. All this area here in red, most of this, not Crimea, but most of this area here is very fertile area. This is wheat and corn country. That has not been in production for the last 3 years. I don't want to spend a ton of time going through fundamentals. I want to kind of overview talk a few things. We're not going to go through numbers here. There's a ton of numbers on the screen. But we did get a game changer kind of number at the beginning of the month. So when I think about the corn balance sheet, when I think about the soybean balance sheet, when I think about global supplies, we tightened those up on January 10th. Our stocks-to-use ratio went from 13 or 14 last fall to 10.2. We're getting closer to, the stocks-to-use ratio, and I don't know, we might not have a lot of grain folks in the room. I know this is a livestock industry conference and group of people, but when you get into any kind of fundamental analysis, these are all the numbers that everybody wants to debate ad nauseum. If you're really thinking about price, this is the only row of numbers that matters. How much do I have at the end of the year in relationship to what I use? My stocks-to-use ratio. What's the stocks-to-use ratio of global corn, U.S. corn? Global beans, domestic beans. Global meal, global oil, domestic oil. That's the only number that matters if we're going to have a $4 corn price or a $7 corn price. When we're above 10 in the 10, 11 range or higher, we're usually downward sloping on price. When we're in the 8, 9 or 7, 8, 9 range, we're usually upward sloping. That's just math. It's nothing magical about it, but that's just a tightening supply-demand balance sheet or a heavier loosening one. So that's where we're at on corn. We tightened it up because we dropped dropped yield, 3.8 bushels per acre yield drop on January 10th. I don't think it was because yield actually dropped that much. I think it's because we had one of the driest falls and fastest harvests we've seen in a very long time. I've got elevators in the central part of the country that their average corn handle moisture was about 11.8%. When you're used to paying for 15% of water is what you're allowed. Okay, the difference of what came in was less water came across the scale, therefore less bushels. If there's something I could change in the world of academia as it relates to this, I would love to get rid of the bushel. I would love to get rid of test weight. Okay, why? I'm going to pay you this much for 56 pounds of corn. I'm going to pay you this much for 60 pounds of beans and this much for 2,000 pounds of meal. Now you got to meet a quality spec, yes, but the bushel doesn't really do it for me. Anyway, that's a tangent. That's a pet peeve of mine. Let's talk about the relationship of corn to soybeans. I know I'm in a little bit of a livestock country here a little bit, but also you guys produce a fair amount of corn, milo, etc. We are expecting a pretty significant switch to more corn acres this year in the United States and around the world, and it's 100% driven by price. This is a very colorful, squiggly line looking chart. All it is the price of beans divided by the price of corn. Nothing special about it at all. No magic. Not an AI-generated anything. This is the price of beans divided by the price of corn. 2.4 to 2.45 is average. That takes roughly the U.S. producer's break-even price relationship in this country and says they make about the same amount of money or lose about the same amount of money growing corn and growing soybeans. You look at the dark green line here, it's one of the lowest ratios we've had in a very long time through the winter. This is showing 10 years of squiggly lines. And it's clearly pointing to more corn acres. We are absolutely expecting 3, 4, 5 million more acres of corn to be planted this spring if Mother Nature allows that to happen. We had better performance on corn last fall, so we're always kind of creatures of habit. The most recent memory we have this past fall, corn outperformed beans on the farm, and I'm giving you a financial incentive in the marketplace to grow more corn. We're going to grow more corn this year. It's a universal comment across all of the winter talks that I've done in every state in the Corn Belt. We're going to plant more corn. Let's talk about South America for a minute. I did not have time to change the stats on this, so forgive me. This is Mato Grosso. Everybody knows Mato Grosso. We've talked about it a ton for the last 20 years. It's the biggest agricultural producing state in Brazil. You can see a shaded area in the middle there. That's the state of Indiana. I did do this similar talk to that Purdue University a little bit ago, so don't hold that against me. And it was Indiana. We can fit 9.6 Indianas in the state of Mato Grosso. That's how big it is. Number one producing state in Brazil. This is the United States overlapping the northern part of South America. So that's just a little bit of a size comparison. But let's get into some numbers. Okay, let's get into some trends, which is really what I want to get across today, and kind of tie a bow on it at the end. This is the amount of acreage expansion in corn. I'm going to go through beans in a minute. It's a bean-driven number, but I'm starting with corn. In the last 22 years, every year but 6, Brazil has expanded their corn acres. They grow corn behind soybeans. It's a second crop. The average yield of corn in all of Brazil is barely 100 bushels an acre, and that is because it's a second crop. It's no different than us having 25 bushel beans behind wheat. It's our second crop. Corn is their second crop. They grow all year round in a subtropical environment. Their driver is beans. Okay, that's what they do, and that's what they do well. But as they increase on an average of 2 to 3% per year their acreage base, they are also increasing their corn acreage base. I don't have a slide on this, but what is the acreage? What is the land, the production agriculture land base in the United States doing? Is it increasing or is it decreasing? Decreasing. It's decreasing on an average of about 300 to 350,000 acres a year when you look at all principal crops. The biggest of those is corn and beans. Corn and soybeans together have been the least affected by that 350,000 acres. Anyone want to throw out a number that's been the most affected by the reduction in acres? That would be wheat. Okay? Wheat's down substantially in the last 20 to 30 years. We're losing about 350,000 acres of principal cropland per year in this country. All right, if I had a $100 gift card, and I don't, but if I did, I would love it to give it to somebody who if I just threw out an answer, what are we losing the ground to the most? Number one. Residential, urbanization, absolutely, that's correct. Number one, residential. You know, you see it everywhere. I mean, one of the ones that I always use a lot is every time I drive around Des Moines, it seems like 2,000 acres are gone around Des Moines. It's just an expansion and an urbanization throughout the middle part of the country. More recently, we have seen a lot of solar fields. We've got a few thousand acres in central Illinois that got put into solar fields just this last year. Anybody want to guess how much of a lease payment that those, it was actually 4,000 acres, central Illinois, prime farm ground, 245 APH, okay? All solar fields now. Anybody know what his payment is for the next 30 years? Bonded payment, because he's next to a power station? Any guesses? $2,000 an acre. You are very, very close. It was $1,900. $1,900. Well, I wouldn't farm it either. All right? Yeah, in 30 years, I'm going to get something back that I'm going to have to spend a little money on, a little work on, or something to get it back into a field, if ever. But if I'm the guy making that decision, I'm going to say that's the next generation's problem, if I'm just putting my business hat on. There's a lot of guys that won't do that because they don't want to lose that farmland for the next generation, and I get all of those things. But in a pure business decision, there's other uses for this farmland that pays better than farming a lot of times. We have to think about those things, okay? Production growth of corn in South America, we're average 3.5% a year. We're increasing 255 million bushels per year on average for the last 20 years in Brazilian corn production. In the 80s and 90s, okay, I'm going to go through this. That's kind of this area of the chart right in here. Every bushel of corn that was sold to the world, roughly 75 to 80% of it originated in this country, the United States. That's that black dashed line. Today, that number has fallen a couple times below 20%. We've had some months below 15%, but we're right in the 21, 22 to 25% range. We were 80% of world trade on corn, now we're low 20s. It's because world production has changed. World origins have changed. World buyers have changed. Okay, you see the growth in red. That's a wonderful looking chart. You see our growth or lack thereof in blue, so our participation is substantially lower. Let's go to this domestic soybean side real quick, and then we'll finish on international. The domestic soybean side, going through a major change on the soybean side. If you want to see short-term price spikes in agricultural products, you have a drought. If you want to see long-term, 2, 3, 5-year price adjustment periods over time, that is kind of that sustainable boost to cropland production, grains and oilseeds production, you need a demand driver. Supply drivers last about this long, demand drivers last substantially longer. When we came out with ethanol, which might be a dirty word in this room, but when we came out with ethanol, we had a boom from 07 to 12. 12 was a drought year. 07 to 11 was a 4-year boom for a return per acre corn farmer. We have been experiencing a boom for the last 2 years because of the Inflation Reduction Act, building soybean crush plants in this country to make more soybean oil to feed the renewable diesel sector that we now have a ton of uncertainty about. We've added about 8 to 9, one of them's not quite up yet, 8 to 9 new soybean crush plants in the last 24 months. A couple of them in Nebraska, one at Cherryville, Kansas. You got one in this state here. Bartlett put up Cherryville, Kansas. You've got some in Iowa, a couple in North Dakota. We were using about 600 million bushels more soybean demand for our domestic consumption number from the crush industry. We've backed that off to about 450. There's about 3 or 4 plants that we have that have not started construction yet that I don't know if they ever will. Because capital has fled We don't have a lot of certainty around the renewable diesel policies and the tax incentives and carbon intensity credit scoring that's going to happen, as I mentioned earlier in this, that we've taken some of those off the drawing board. CHS is the most recent one. They were going to build a 40 million bushel plant in Wisconsin. Today they're not. So this balance sheet here has gone through a bunch of change right in through here. This is $14, $15 soybeans. This is $420 meal. Okay, now we're sitting at $10.50, $10.70. We're sitting at $3.10 meal, $3.15 meal. And we have one of the heaviest balance sheets around the world because Brazil's got the biggest crop coming that they've ever had. This is where we produce soybeans. Okay, here's Kansas. Kansas is not the #1 soybean producing state in the country. Okay, in fact, when I talk in Kansas and Nebraska, usually soybeans are a bit of a dirty word. Here's Cherryvale's down in here. This is the amount of millions of bushels in each one of these ag statistics districts. Okay, those aren't counties, they're ag statistical districts. They combine about 10 or 11 counties to make those up. This is where beans are produced all across the country. This is where the processors are. So this is the consumptive side from the crush industry, very heavily weighted in western central Iowa, down this corridor. Okay, that's where some of the cheapest bean basis levels are. You also got obviously a piece in here in the east, which feeds a lot of that southeastern meal demand for poultry and hogs. This is a net balance of where we produce beans in relationship to where we crush them. So you see some hollow circles in here. These are areas where beans are deficit because we have more demand in these areas than what we have supply, so we have to bring those in from other areas. And this map has been shifting. These are the 3 most important slides I show an investor group on where do I build a soybean plant. Okay, we did this exact same study 15 years ago. Where do I build an ethanol plant? First of all, you got to have excess production in relationship to existing demand. You need to have some rail lines that come through that area to give you some optionality, and you need to have market access. Where do all those lines cross? These are some maps we look at to say, okay, where am I going to start? I'll usually overlay a railroad map, and then I'll overlay some basis levels. And that's how we do a lot of location evaluations for ethanol plants and crush plants. Here's the 2 ethanol plants that went off the board in the last couple of months, one in Mississippi, the one I mentioned in Wisconsin. Every crush plant today in the country is losing money. Every crush plant in the country. One of the biggest reasons they're losing money, of course, the cost of beans versus the price of meal, price of oil, that's the 3-legged stool of crush margin, but the cash margins are even worse. Okay? What's the price of meal locally in basis terms? Does anybody know? Anybody buying soybean meal here? You guys grow hogs, right? So, I mean, I think you should. 30 under. That's actually higher than I thought somebody would say. You're delivered. You're right. No, you're right. 30 under coming from western Iowa in a lot of places. It's about 55, 60 under FOB where a lot of these plants are right now producing soybean meal. For the last 3 years, that soybean meal was option price, $5 over, $10 over. Today, it's 60 under. That's the big hit to margin today, okay? That's the big hit to margin. All these plants were built for oil. The meal, we've all got plans on how we're going to get rid of that meal. It's not like all of a sudden, oh my gosh, what are we going to do with all this soybean meal? We knew that. We got a nice boost because Argentina had half a crop in 2022. They're the largest exporter of meal to the world. So we got a nice boost there for some of those new plants with our exports. Now we're really finding the devil in the details, the challenges of getting rid of all this meal that we've added, that 400 some odd million bushels of crush capacity. Okay? Soybean meal. Here's where we're surplus, here's where we're deficit. Kansas is actually with the Cherryvale plants, if you look at the whole state, as a consumptive end user of meal in the state of Kansas, you're actually surplus now because of the Cherryvale plant, but that was not always the case. Most of it's all in that Midwest, Iowa especially, 8.3 million tons coming out of Iowa alone, and then the destinations where we use them at. Here's North Carolina, negative 2 million tons. We export almost 7 million tons. Texas, 2.5. California, almost 2 million tons. So you see what I'm looking at there domestically. Let's talk about the international elephant in the room. 20 years ago, the United States was the largest producer of soybeans. Today, we're half the size of Brazil. You look at this chart here, this is a stocks-to-use ratio. Again, this is taking that one line on a fundamental chart that really determines price and graphing out that one line, global soybean stocks-to-use ratio. We are over 30%. World ending stocks are almost 35% of total world use. Far chart here on the top. We are only second to 1 year. This is 2018. Everybody remembers what happened in 2018, right? Why this one spiked the way that it did? That was Trump Trade War 1.0. Okay, so we have a very burdensome supply of soybeans on the marketplace today globally, led by Brazil. Out of the last 22 years, we have only decreased soybean acres in Brazil twice. Only twice in the last 22 years. The average is over 3.5% increase, some years as much as 10%. The higher this percentage increase is, directly correlates to price. When we have $13, $14, $15 beans, we expand to more acres in Brazil faster. Plain and simple. Okay? South American production over the last 20 years is on a 3.5% growth rate, 257 million bushels per year. Brazil has doubled, 98%. Doubled in the last 10 years. Argentina's flat. Last year was a record for South America, 218 million tons. This year, 238. One of the drivers in the marketplace today, we're talking about Argentina's drought, and that drought might take 3 or 4 million tons of beans off the market, but Brazil's got a record by almost 20 million tons. We have a very heavy bean situation around the world. Same chart for beans as I showed for corn. We were in the 80% for our share of global trade of soybeans earlier on in the 70s, 80s, 90s. Now we're down below 30%. Let's talk about Brazil in a little bit more detail. So one of the biggest challenges in Brazil continues to be, I guess I'll need this for the pointer, continues to be infrastructure, okay? Brazil moves grain in and out within the country via trucks. 99%. They have very short-term barges, very short-term rail. They do not have anything that spans the country other than trucks. If you go back 20 years ago, all the ports were down here. Santos, Paranaguá, these are your two big ones right in here, a couple little ones along here. These were the ports, all down here. This production that was at that time right in here all had to flow south. The expansion of these northern ports has happened over the last 10 to 15 years. We have doubled the capacity that they can export grains out of that country. Do we know who paid for those ports? There's really two. China is always the one everyone says, China. I'm going to put China at about 40 to 45% because the Brazilian government does have some rules on these ports. They're going to own 51% of them. So the other 49% is up for grabs, and China has the vast, vast majority of all of that. Okay, so we're building all these ports in northern Brazil. Here's one of these ports, Santarém. What's unique about Santarém? If I showed you that picture, I know we're not anywhere near a massive body of water out here in Manhattan, Kansas. But if you saw that, you're going to say, okay, that's a port. That's got to be near an ocean. We load grain into that. We can load all sorts of things. Load it in about 2 days. It holds about 2 to 2.5 million bushels of something. And away it goes to a world market. That port is on a river. That port is Santarém. That port is right there, Santarém. Grain flowing north to this port. A little bit of barge activity actually gets to that. This is equivalent to us loading this vessel in Memphis. That's what this is equivalent to. All of our vessels load in New Orleans, off of the Pacific Northwest, or a few off of the East Coast. We have to be near the body of water for us to have 40, 50, 60 feet of water to load a vessel in. They're loading it at a river. They're loading it at the mouth of the Amazon interior, mouth of a tributary river in Santarém. That opens up a dramatic advantage from a freight perspective to Brazil. The biggest disadvantage Brazil has had for a long time is this is a long, long distance to go from production to port. And they keep shortening it every day. Here's the other one that I wanted to show you. Port of Itaqui, also up north. This one is on the ocean. It's up right there. We have 2 facilities in New Orleans that can load 2 vessels at a time. 2 that can load 2. CGB has one, and Cargill has one. This is 7 vessels. Okay, this guy isn't loading anything. The other 6 all have belts going out to them to load. This is 1 port, 1 destination, 6 vessels berthed at the same time. We have nothing like that in this country whatsoever. This is the capacity build that's happening in Brazil. Okay? You see Back in 2011, when they exported about 60 million tons worth of soybeans and corn combined, the green part of that bar is how much came out of northern ports. Oh my goodness. Yeah, whew. Right there, here's the expansion of the northern ports. The green bar getting taller and the total getting bigger. Where's this expansion coming from? I get this question all the time. How much more can they continue to expand? If I'm talking to a group of grain farmers, okay, corn and soybean farmers in particular, how much can they continue to expand? You've showed me 3.5% for the last 15 to 20 years. How long can they keep doing that? The answer is at least another 20. At least another 20 at 3.5%. The Cerrado region, the purple region of this, one thing I need to be clear on, this is not the Amazon. We get into the climate sensitivity, the Green Initiative talks of Brazil sometimes, and we think about land expansion like we're ripping up the Amazon. We are not doing that. They are not doing that. They are converting very poor pasture land into soybean production land, and they are not touching the Amazon. Somebody might be able to give me one picture somewhere, okay, but that's not where it's happening. The Cerrado is where it's happening, okay? This is what the Cerrado looks like, right there. That's nothing. That's pasture, and it turns into that. That's the expansion, okay? Yes, sir.
So we've been talking about infrastructure restrictions on Brazil being their crutch for a long time.
Right.
Is it going to be for another 10 years, and then all of a sudden we get slapped in the face and it's a real deal? How much longer are we going to talk about before it actually gets solved? It's not a criticism to you.
No, it's a great question, and I usually actually throw that piece in there, and I didn't. The question was the infrastructure and transportation challenges of Brazil. Why are we still talking about them? I mean, we can still see pictures of 3-day bean lines at ports. I mean, that's ridiculous. Why aren't we doing something better? I mean, it's not like it's a new problem. The biggest challenge in Brazil, you would think someone like a Union Pacific or a BN Railroad would come in and say, my gosh, there's an opportunity there. And there would be if Brazil's topography didn't have these massive inclines and elevation drops that are like plates that run through the major producing regions of the country. It is very, very difficult to imagine rail in the center part of Brazil. That's why all of their efforts are along the river systems and northern ports to cut down the trucking time. But if you're going to rail, you're not going to be able to rail very far. I wish I had a chart of it up here. I do sometimes, or a couple of pictures that will show you you'll have a field that's got a combine harvesting on top of it, and then a half a mile later, your elevation drop is 200 feet. And then you have another field with a combine running across it. You can't get rail across that. You might be able to, we can dig a tunnel through the Rocky Mountains. I would think we could do some things to help address that. But so far, the emphasis has been on northern ports cutting down the trucking time, and also the infrastructure of the energy it takes to go into all this new area of production. Remember, these places don't have towns. There's nothing up here yet. There's no electricity. There's no nothing. So we can only advance as fast as some of the power will get us there. But so far, because of the topography of the land, it's just not conducive to rail. It moves up and down too fast. It's a very good question, though. I'm thinking of the picture of the slide I show sometimes in my mind, and I wish I had it here, but that's what it looks like.
What's the average yield on beans?
Same as ours. Yep. They can have 70 bushel beans just like we can at times, but their average is in that 51, 52 range just like ours. They will likely have a record yield this year by a bushel or so. Theirs are measured in sacks per hectare, but it's roughly the same. Their corn yield is much less. Their corn yield's about 95 to 100 bushels per acre, but their bean yields are almost identical. I also get the return per acre farming question quite a bit because land's so much cheaper down there. This land right here is much cheaper than some of the stuff that might have traded in the last year in Kansas. Okay? Transportation costs are way higher in Brazil. Land is much cheaper. Most everything else works itself out. I showed you a picture that had Indiana inside Mato Grosso. Purdue Extension did a big study on return per acre for an Indiana farmer versus a Mato Grosso farmer, and you couldn't find an eyelash's difference on soybeans between the two. All things factored. Various costs were very different, but the net return per acre was almost exactly the same. The Cerrado biome, this purple area. Okay, it's 253 million acres of native vegetation, 490 million acres is the total, 253 million is the native vegetation, 89% of which is privately held. Of that, 237 million is in agricultural production and pasture lands. Of that, 57 million acres of soybeans are produced in the Cerrado region, which is 50% of the total country's acres. And that number is up 49% in the last 9 growing seasons. I know there's a lot of numbers on that page, but that's the stats. 95% of the expansion has come from this right here, the pasture lands. Not as much the native area, but the pasture lands. I'm sorry, I said that only 5% has come from the native vegetation. Conclusion and the stated goals of the government of Brazil is that they want to double the amount of soybeans produced in Brazil in the next 10 years, and that is just simply a continuation of the past 10 years, is all that is. Now, you're doubling a bigger number, so it's a bigger feat, right? Just math. The narrative does fit with their climate goals because they're not touching the Amazon when they do that. I wanted to finish with, I don't have a slide on it, but I wanted to finish with just a couple of comments. And this is more big picture, more ag policy, more, if Brian Burke was the Secretary of Ag, what would I be saying? Okay, and I'm not the Secretary of Ag, okay? We all know that, and I'd have no intentions to ever be. This country, and I fully understand that this presentation is being recorded, but I'm going to say it the same way that I would have said it if it wasn't being recorded. This country is losing a battle in whole grain exports, and it's not going to change. Our whole grain exports should not be the policy of the U.S. Grains Council. It should not be the policy of the United States Department of Ag. It should not be the policy of the EPA. We can't compete against more acres at 3.5% and a doubling of soybean production with all of the advantages that Brazil has, and we might throw the Black Sea region of the Ukraine back onto the supply side of this thing, and we need to throw on the fact that some of the buyers really don't like us, number one being China. We need to pivot, and we have. We've got examples of that pivot. That pivot is we need to add value to agricultural products here and figure out how to market those agricultural value-added products in a better way. That value-added product might be a pork chop. That value-added product might be a ham. It might be a renewable diesel that was sourced with soybean oil that is exactly the same as a gallon of diesel that comes from crude oil. Let's get that fact straight first, too. Renewable diesel and biodiesel and diesel are all three the same thing. Excuse me. Renewable diesel and diesel are the same thing. Biodiesel does have a little bit different freeze point. But they're all in the same pipelines. You could be filling up your tractor trailer today and it might have 5% renewable diesel in it. It might have 25%. You don't know because it's diesel fuel. Some of it was made from crude oil. Some of it might have been made from soybean oil. It's no different. It's in the same pipeline system. It's the same as diesel fuel. So that's another value add. Okay, let's think about other sectors. We can go down a renewable energy policy path for adding value to our domestically produced corn, soybean, wheat, milo farmers. We can go down a livestock value add all the way through the chain, all the way through the system. We're long food. We're long protein. The worst way to ship that protein or that food or to be food out of this country is to add the least amount of value or ship it out in its least valuable form. I don't want to compete with the rest of the world shipping out the least valuable form of protein, which might be a soybean bushel or a corn bushel. I would much rather send it out as a pork chop. I would much rather send it out as a renewable diesel gallon made from soybean oil. So that's where our value-add focus needs to be, in my opinion. I think that's where our efforts need to be focused, because if we're trying to compete head-to-head against our South American friends, farmer friends of the south side of the equator, we're going to lose. I'm just going to say it. We're going to lose. We will have price spikes when they have weather problems, more so than when we have weather problems if we're going to fight that battle. We have turned to being the world's residual supplier of corn and soybeans in 10 years. We were the world's featured supplier of corn and soybeans. Now we are the world's residual supplier. Our export season for corn runs from about February to June. That's our peak season now. And that window is going to keep getting smaller because the rest of the world is going to take over during its crop cycle in a bigger way than ours. So we need to really shift, I think, a lot of those ideas about how we add value to our agricultural products here in this country. Think of all the labor benefits, not labor benefits, the job benefits, okay, the job opportunities when you're adding value to a product like that, as opposed to shipping it out in its least valuable form. So I wanted to end on that note. I'm very excited about agriculture. I always am. Agriculture's a business that I love in all forms, and I think we've got a very, very bright future. But like every single year, it has its challenges, and this year is going to be no different. We're going to have things that come across the headline, to tie it back to our first couple of comments, that we're going to be like, what? What was just said? What was just tweeted? That makes no sense. Okay? I don't care whether the boats go out of the Gulf of Mexico or the Gulf of America. They just got to go out. I don't care if we own the Panama Canal or Panama owns the Panama Canal. It just has to be efficient. Okay, I'm not trying to get bogged down into some of those things that really occupy the headlines. We need to be value-added focused and efficiency focused in all of our businesses, and you all know that. The speakers before me talked about it a lot, and it's within every single segment of ag. But I wanted to really hit on the importance of adding value here first before we export it out. That's what I got. Thank you.
Thanks, Brian. Does anybody else have any other last questions for Brian before we push him off the stage?
Yes, sir.
How does it change the market with soybeans if the cooking oil
Yeah, so the used cooking oil, there's already been a temporary ban and a selective ban on imported used cooking oil from China and Malaysia and other places. So that kind of, I'll call it a loophole, even though it wasn't really a loophole, but that was stopped. And so that did cause a pretty quick rise in soybean oil prices. So the effect of that policy is bullish to the vegetable oil market, is bullish to the energy market. One of the challenges I see that kind of offset that, and that actually gets it back in line to what the intention was around the 45Z Inflation Reduction Act renewable diesel segment of that bill. The challenge that I see with that, though, is we've pushed a lot of capital away. Okay, capital likes certainty, and we don't have certainty in this business, and that's a big problem. But I would say, too, to minimize the amount of subsidy that is given, there needs to be also a larger spread between crude oil produced renewable diesel, or diesel, and renewably sourced and produced diesel. And we've got a drill baby drill president, and so are we going to be $75 crude or are we going to be $60 crude? Most of the people in this country, if asked that question, they're going to say $60 crude, baby, right? I mean, that's what we're going to say. But for that segment, that's a challenge. Thank you.
Let's thank Brian one more time. And, appreciate him coming in.